Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the final hour of trading as we count down to the holiday weekend. You're looking at gains across the board. Traders, investors really betting on the fact that they are hopeful that lawmakers will be able to reach a deal on the debt ceiling down in D.C. You're looking at the Dow up 334 points, the S&P up over 1%. But take a look at the outperformance from the Nasdaq once again today. And similar to yesterday, it's the same story. AI frenzy really fueling the rally that we are seeing in tech names today. Marvell Technology is the clear winner in today's action on the heels of the results that we got from NVIDIA pointing to much further growth here in the future. So that's driving today's action. Again, the Dow up 330 points, Akiko.
Yeah, Shauna, the other focus today, inflation. The personal consumption expenditures index showing prices rose 0.4% last month, higher than expected. Core prices, stripping out food and energy, also came in above expectations. This data now has the odds for a rate hike next month rising. The CME's FedWatch tool pointing to the probability of a rate hike at nearly 60%. And Shauna, this only adds to that huge swing that we have seen in expectations for that meeting, the Fed meeting come June. You know, I was looking at some of the comments that we got from Fed officials as recently as last week. We heard Jay Powell say that he believes a potential pause may be on the table or should be on the table because of the lagging indicator or lagging factors of those rate hikes. He also talked about concerns around credit tightening. And yet all the data that we've gotten seems to suggest that, number one, the inflation is coming down, but not as quickly as we like, but also that the demand is still strong. We saw consumer spending out today, still pointing to consumers out there pushing higher in terms of shelling out more money.
Yeah, if you take a look at the data obviously has been extremely strong. That is why we have seen a total flip here just in terms of the expectations for that June meeting. You mentioned consumer spending. That was up about 0.8% last month, and that comes on the heels of what has been a very resilient labor market. We also know that business activity has been picking up, another bullish sign here for the economy going forward. So now more and more traders are betting on the fact that we will see another rate hike in June. When it comes to some of those inflationary numbers that we got out this morning, price increases were spread pretty evenly when it comes to goods and services. Goods rising just about 0.3%. Services were up 0.4%. And although we have seen food prices come down just a bit, or some of that pricing pressure ease is a better way to put that there, prices were still up nearly 7% from a year ago. So yes, we are making some progress when it comes to certain measures on inflation. But when you compare that to the 2% target from the Fed, we certainly have a ways to go.
Yeah, well, we are certainly way off. And that's sort of, you know, for all the conversations about where the Fed is, it's sort of important sometimes to kind of bring it back to what that mandate looks like. And to your point, 2% is way off of where we are right now. We still have a few more weeks to go, though, until that meeting.
That certainly is a tough job right now. And who also has a tough job is the lawmakers down in D.C. because the U.S. is getting increasingly closer to reaching the day it will no longer be able to pay its bills. And yet there is still no deal to raise the debt ceiling. Even if we were to get a deal today, it would likely not be voted on until next week because the members of the House are allowed to leave for a Memorial Day break. Joining us now is Bobby Kogan, Senior Director of Federal Budget Policy at the Center for American Progress, also former advisor to the OMB Director in the Biden administration. Bobby, it's good to see you here. So time is ticking, although D.C. has been awfully quiet today. What does this signal to you just in terms of, is this maybe a sign that we are getting closer to a deal? All right, it looks like we're having a little bit of trouble with Bobby's audio here. So we're going to work on that. So we're going to try and work on Bobby's audio and get him back. But in the meantime, let's talk about the latest data out from the IMF. The IMF's director is urging the Fed to remain hawkish to tame persistent inflation. Now, we got comments coming today after IMF met with Fed Chair Jay Powell, Treasury Secretary Janet Yellen earlier today. Yahoo Finance's Jennifer Schonberger has the details on that. Jen.
Good afternoon, Shauna. IMF Managing Director Kristalina Georgieva saying today she thinks the U.S. can avoid a recession this year and that the Federal Reserve will need to raise rates again and hold them at that level until later next year. Amid persistent inflation, the IMF out with a brand new report today on the outlook for the U.S. economy, saying that the Fed needs to raise rates by another quarter percentage point to bring them up to a range to 5.25% to 5.5%. That would be up from the current range of 5 to 5.25. I asked Georgieva about that in a press conference earlier this afternoon. She seemed to suggest there could be upside to that, telling me, quote, inflation remains stubbornly high. PCE is telling us that the job is not quite yet done. She went on to say, frankly, we need to continue to follow the data and see how much it would take to bring inflation back down to target. The IMF now sees inflation falling slowly, ending the year only around 4%, and expects inflation will remain above the Fed's 2% target through next year. Georgieva met with Treasury Secretary Yellen and Fed Chair Jay Powell this morning. When I asked her how the meetings went, she told me there was, quote, significant convergence between the views of the Fed and the administration and of what the IMF is suggesting. She added the caveat there that there are aspects of the recommendations that the teams would reflect further on. Now, Georgieva called for the debt ceiling to be raised immediately or suspended, saying this is an avoidable risk for both the U.S. and global economies. She says we're in the 12th hour right now. She drew an analogy to the fairy tale Cinderella and how Cinderella had to leave the ball by midnight. She says, we are there right now. Before our carriage turns into a pumpkin, can we please get this solved? The IMF chief calling for a permanent solution to avoid this sort of brinksmanship in the future. Though having said all that, the IMF does think that the U.S. needs to deal with its debt situation, and they think that revenue raise could be part of that solution, suggesting that there should be consideration for a broad-based federal consumption tax, a carbon tax, as well as higher taxes on corporations and wealthy individuals. Guys?
All right. Interesting analogy there. I didn't think we'd be talking about Cinderella and the Fed. Jennifer Schomburger, thanks so much for that.
All right, well, the U.S. is getting increasingly closer to reaching the day it can no longer be able to pay its bills, yet there doesn't seem to be any sort of deal coming out of D.C. just yet. Even if we were to get a deal today, it would still not likely be able to be voted on until next week because the members of the House are allowed to leave for Memorial Day break. Joining us now, we want to bring in Bobby Kogan, Senior Director of Federal Budget Policy at the Center for American Progress, also former advisor to the OMB Director in the Biden administration. Bobby, it's good to see you here. So let's just talk about where things stand now in D.C. We haven't heard a heck of a lot coming out of D.C. today. Do you think that means that we're getting a little bit closer to a deal? All right, Bobby, it seems like we're still having some issues with your audio. So we are going to take a break. We'll try to get that fixed, and we'll be right back.
3, 4, 5.
It's Memorial Day weekend, the unofficial start to summer. President Biden may finally get something he called for 2 years ago. Yahoo Finance senior columnist Rick Newman is here to tell us what it is. Rick, what can we expect? And we don't have Rick, so we're going to try our second best option here, or maybe he's first best, I don't know. Jared is keeping a close look at some of the movements that we are seeing in yields today when it comes to treasuries as we do count down to what hopefully will be a deal this weekend.
Yes, I mean, we're tracking two huge themes in the market right now. One is the debt ceiling. The other is this incredible bifurcated market that we have where tech is just exploding at the risk of, or at the cost of everything else going down. Now, here's what's happening this week. Just want to show you this week's price action. For the Dow, it's going to be down about 1%. Then you take a look at the Nasdaq. It's up 2% today. It's going to be up over 2.5% for this week. And the Nasdaq 100, by the way, is going to be up over 3%. So this doesn't happen very often where you have the Nasdaq 100 up so much, over 3%, and the Dow in the red. It's only happened 3 times since the bear market began last year. And then you'd have to go back almost 20 years to get a cluster of signals like that during the dot-com bubble and bust. So here's the Nasdaq 100 real quick. Then we're going to get over to the debt ceiling. But I just want to show you the performance on the left side of the board. NVIDIA up 25% over the trailing 5 days. Alphabet up a little bit, Microsoft up 4%, but you take a look at the equal weight this week, huge outperformance on the top row, Marvell up 43%, but then all these staples that hedge funds had been rushing into, guess what? Those are getting whacked this week. So very much the pain trade is on and a lot of frustration for a lot of traders, not just retail, but institutional. Now, let's talk about the debt ceiling. Here's the headroom under the debt limit that the U.S. Treasury has. And this is a Goldman chart, and they have 3 scenarios. The purple line is the central. Then they have the upside scenario, which is a little bit rosy, and the downside, which is a little bit pessimistic. But what you want to watch for are these lines hitting the zero bounds. So, for instance, the orange line, the pessimistic scenario, has the Treasury running out of room by about 6/6. That's June 6th. Next week, and Congress would have to act before that, well before that, in order to get ahead of it. And even if things go well, the central scenario, we would run out of money by 6/9 of next week. And then there's no scenario where the upside breaches that, but you take a look at what happens. We get some tax receipts in the middle of the month that could help the Treasury out. By the end of the month, even the central is back down to the zero line, where we would have to invoke extraordinary measures. Now, I also want to show you what this has been doing to the T-bill market. These are very short-term bills, and this is the interest rate right here. And you can see 3.2% for a bill maturing basically early next week, and then 6.4% for just a few days later. Why is that happening? This all has to do with the debt limit, and also people do not want to hold a lot of this paper that may be coming due after the Treasury runs out of money. So all of this is decreasing the amount of leverage that's available for all these side bets in AI.
Certainly very important here to keep an eye on. All right, Jared Lickery, great stuff. Thanks so much.
Well, the Fed's preferred inflation gauge headline and core PCE rose 0.4% last month, pointing to persistent inflation. As we head into the summer season, could elevated prices continue to be the running theme? Let's bring in Jay Hatfield, Infrastructure Capital Advisors CEO. Jay, we were talking about the numbers that we got out this morning on PCE. It certainly puts the Fed in a bit of a difficult position, although increasingly it feels like the expectation is swung towards another rate hike. How do you think the central bank processes the data we got today?
Thanks for having me on, Akiko. Well, this central bank, as you're pointing out, does focus on PCE core, which we think is very misleading. It's overstated by about 1.5% because it used a very lagged component for shelter. But it is entirely reasonable the Fed will raise rates because they're normally a year behind. And if you look at the data carefully, inflation absolutely peaked in June and then started declining in July. In fact, our own index, CPI-R, real-time inflation, has declined since July by over 1%. So we really think we're into deflation, and this Fed, just like they were with transitory, is completely off. But that means because they're so lagged, could very well raise rates in June, even though they shouldn't.
Jay, so if we are seeing inflation maybe declining more rapidly than some of the data is suggesting, how quickly then could we potentially get back to that 2% level?
Thanks, Shauna. Well, we think that we could get there, maybe not the reported numbers, but any reasonable adjustment of the numbers by the end of the year. In fact, we've done a forecast that headline CPI year over year, as of June, reported in July, will be only 3.5%. So everyone will be able to figure out, except perhaps the Fed, that inflation's rapidly declining. But that process will continue because a lot of bringing inflation out of the system is simply anniversarying the height of the inflation. So July and August and September will be after those peaks. So the data should start to support what we see as what the leading indicators are telling us, both PPI and CPI-R.
I mean, with that said, there are concerns about where the economy is headed. You could argue today's data certainly points to the resilience of the consumer, and demand is still strong. And yet I wonder if you think there's always a lag factor with data, but you think the Fed is especially behind. I mean, what does that trajectory look like going into year end?
Mm-hmm. Well, that sort of gets to it's a great question because it gets to the core of the problem with the Fed's forecasting framework. They use the Phillips curve, which hypothesizes that all inflation comes from the labor market. So they would naturally be concerned, probably raise rates because we have a strong labor market. But really, if you look at the data, inflation is almost always caused by rapid inflation in housing and commodity shocks. In fact, in the 70s, very little people know this data, oil prices rose by an unimaginable 1,200%. So that's like our oil going from 100 to 1,200, which would just cause massive inflation. So that was the key driver, not wages. Wages typically are a lagging indicator. Real wages will actually decline as they have recently. So that's why we think this is a fundamentally flawed Fed. They will raise rates, and they probably won't cut them till March. They should have cut them in March when we had the banking crisis, so they'll probably cut them a year late next year in March.
Jay, what does all this then mean for a recession, just given the fact that, yes, inflation is high, but when you take a look at a lot of the economic data coming out, specifically what we're seeing from the consumer, what we're seeing in housing, it's remained very resilient. Do you think we're going to be able to avoid a recession even if the Fed hikes again next month?
Well, that's also the key question because it's very, very normal when you have an inversion and tight Fed policy to have a pretty significant recession. But if you think about the transmission mechanism of monetary policy, it's wholly on the housing sector. So that was terrible in 07-08 because we were building 4.5 million homes, had an excess of inventory. Here we have the reverse situation because of the pandemic. So that's why our call is no recession. It is non-consensus because the data, historical data doesn't support it. But keep in mind, we've never, ever had a pandemic in post-World War II history. So we really don't know. But we know we have a shortage of housing and autos. So we're not getting the layoffs. And if you look at construction spending, it's very resilient. We have the infrastructure bills out there supporting construction. So that's why our non-consensus call is actually estimating 0 to 1% growth this year. So slowing, but not a recession.
Let's talk about strategy now and where investors should be putting their money. You say you like the tech sector. You're certainly not alone in that. We saw this week just how much exuberance there is around artificial intelligence. How are you looking at that space? Is the better bet here on the chips or the tools that will help build the technology or expand the technology? Or is it about the Microsofts and Alphabets who are really leading where this technology goes?
Well, our key insight that I really got being an investment banker is that when you do have these new technologies, it's actually functional, and what makes the U.S. have a huge advantage over China and Russia is that you get an overvaluation of the companies that are public, and then that drives innovation and investment in private companies, and eventually they go public, and then that's when they come back to normal valuations. So that's kind of the key insight. We've seen that with Tesla, where they were arguably overvalued, then you get a lot of IPOs. So we think that's going to continue. So we would hesitate to get out of the AI trade. It's obviously going to have downturns solely on valuation. So we think that with regard to that, I would be, since it's a fairly risky trade, be with the more established companies with substantial earnings, so no startups. People tend to underestimate the difficulty in turning profitable. In fact, when I was an investment banker, we didn't even have Morgan Stanley. We didn't even allow companies that weren't profitable to go public because they're too risky. So we'd stick with the big names, Microsoft, NVIDIA, AMD, and we'd rather be diversified rather than making a big call on chips versus software versus cloud. All of them are going to benefit, and it seems like it's the biggest trend since the internet.
Jay, when it comes to the more overall speaking, the narrow market breadth that we've really seen since the start of this year, does that worry you at all, just about whether or not the fact that this could potentially not be sustainable?
Well, definitely. What you really saw the first half of the year was a pretty broad-based rally, including all the stocks that we manage through ETFs, like preferred stocks, utilities, and MLPs. But then when the banking crisis hit, you saw this massive rotation where all those sectors were sold, financials as well, large cap dividend stocks like we have in ICAP. So if you look at the returns on our funds, they're way up and then now flat to down. But yet tech is skyrocketing because it's viewed as a safe haven, and then you have the AI. So it's been a bifurcated market. Today, tech is dragging the stocks up. Yesterday, they were crashing. We wouldn't really rotate into the more, the dividends and value until you get to July, because then you have earnings. These companies are all doing really well. It's just that they're being shorted or sold by money managers who are underweight tech and need to, keep up with their benchmarks. So short-term outlook for basic economy companies, I would say, is dicey. But in July is when we're going to get more build up on those like preferred stocks, for instance.
Okay. Jay Hatfield, good to have you on today. I appreciate your time.
Great. Thanks, Akiko. It was great.
Well, the U.S. is getting increasingly closer to reaching the day it will no longer be able to pay its bills, yet there still is no deal down in Washington, D.C. Well, joining us now to talk about this is Bobby Kogan. He's a Senior Director of Federal Budget Policy, the Center for American Progress. Bobby, let's try this once again. So where things stand right now coming out of D.C., how confident are you that we're going to see a deal come this weekend?
Shauna, thank you so much for having me on. I'm pretty confident. You should always hedge a little bit, but I think the fact that we're seeing a lot of folks not saying anything is an indication that no one wants to rock the boat. No one wants to do anything to accidentally cause an issue in the deal that's probably coming together.
We already kind of looking ahead here to number one, the expectation that the deal can be reached, sort of avoiding the worst case scenario, but in the case of a deal, that's got to have some kind of spending limits, if you believe the reports that have been out there in terms of where the negotiations have been. I mean, what does that mean from a growth perspective? How are you looking at that?
Thanks, Akiko. Yeah, I mean, obviously, GDP, government spending is a component of GDP, and so if you're freezing that aspect of government growth, then that will taper back some of the, if you're freezing government spending, that's going to taper back some growth. We'll have to see, kind of what happens. Some of the reporting that came out last night indicates that, it might be more tepid than obviously Speaker McCarthy had originally called for, and we'll have to see what comes out of it. But yeah, I mean, obviously, if you're pulling back government spending, then that slows down our growth.
Bobby, in terms of what the reports are indicating, we could potentially see a cap on federal spending for 2 years. Also, some of the budget that was allocated towards the IRS, some of that reduced. Do you think that is something that enough Democrats would support?
I'm glad that I am not a whip, and I'm glad that I don't have to see. I'm sure that we'll get enough support to pass it. I'm not 100% sure what the composition is going to be. Is it going to be 2/3 Republicans, 1/3 Democrat, 3/4, 1/4? I couldn't tell you there, but obviously there's a lot of people want to make sure that we don't default.
I wonder if we can move the conversation forward, because it feels like this conversation that we've been having around this X date is just a very familiar one. I mean, you can attest to it, having worked inside the government. How do we move the conversation forward here so that we're not sort of having this discussion about a potential default every few years?
I guess what I would say is that the only real historical analog here is 2011. No one was really worried about default under President Trump or under President Bush or under President Clinton or under President H.W. Bush or President Reagan. The debt limit is habitually raised with no preconditions. It was raised suspended 3 times under President Trump. Speaker McCarthy voted for all 3 huge bipartisan things, 7 times under President Bush, again, all bipartisan. The issue seems to be when there's a Democratic president. We almost defaulted in 2011, and there were major preconditions imposed by House Republicans, and we're seeing a repeat of that. So how do we make sure this doesn't happen again? Well, you need political actors to not take the country hostage, and that is a political problem rather than a process problem.
Bobby Kogan from the Center for American Progress, thanks so much for joining us today.
Well, it is Memorial Day weekend, the unofficial start to summer, and President Biden may finally be getting something he called for 2 years ago. Yahoo Finance senior columnist Rick Newman is here to tell us what it is. Rick, that's quite the tease. What are we talking about?
It's not the debt ceiling. Everybody who's sick of talking about the debt ceiling, raise your hand. I've been sick of talking about it since it first came up. So what else is going on in the world? Oh, most Americans aren't really paying much attention at all to what's happening in Washington, D.C. People are traveling this weekend. Gas prices are down about $1.40 from the peak of last June. We have record flight bookings this summer, and travel experts are saying watch out for record crowds. So guess what? There's some good news behind all of this hand-wringing that's going on over the debt ceiling. And the good news is Americans are getting more or less back to normal. It was 2 years ago that President Biden said in June of 2021, hey, everybody, we're going to have a summer of freedom, because that was the first summer with COVID vaccines. But alas, what happened that year was the Delta variant popped up. People got spooked all over again. And then we had a rising death toll in fall and winter of 2021. Last year, we had inflation, $5 gasoline, 9% inflation. This summer might actually be a pretty good summer. So, hey, Congress, get the debt ceiling problem resolved, and let's all get on with our lives.
Get it done so we can all stop talking about it, at least for now. Rick Newman, great stuff. Thanks so much. Have a good weekend.
Bye, guys.
All right, well, coming up, we are talking the state of travel with the CEO of TripAdvisor as we fly into the holiday weekend. Stay tuned. The summer travel season is here, and despite the pinch of inflation, Americans are paying up when it comes to travel. New data out from TripAdvisor saying that the market specifically for travel experiences is growing fast and estimates that the industry is going to be worth about $280 billion by 2025. Here to tell us more is Matt Goldberg. He's the CEO of TripAdvisor. Matt, it's great to see you here. So before we get into exactly what people are paying for, let's just talk about the overall summer travel season. How strong of a season do you expect this to be?
Well, we expect the summer travel season to be strong. You know, Americans are traveling again, and summer travel's back. We can see it in the airports, we can see it on the roads, and that's going to be true. The peak season is off to a great start. So it's going to be one of the best weekends in almost 2 decades. Some travel intent beyond Memorial Day is significantly higher than last year. And the vast majority of travelers are planning to take summer trips this summer, and they're even willing to spend more. Now, it doesn't mean that they're not going to be subject to some of the economic whims. They may make choices about staying closer to home. They may choose to drive rather than fly. But in the end, travel is back, and we're going to feel it this Memorial Day.
Yeah, you know, so let's talk about some of those trade-offs that we're seeing, Matt, because it is fascinating to see, even in the face of higher prices. In the case of airfare, we're talking much higher prices. Travelers are still willing to pay the money there. So as they plan out their vacations, what's the trade down that we're seeing?
We're not seeing a trade down. We're seeing perhaps the choice to go somewhere closer to home, maybe do a slightly shorter trip, and maybe, again, think very carefully about where you want to spend. But the truth is that we have seen over the last year, and it's continuing, a shift from material goods to experiences, travel being one of the most defended discretionary spend in anybody's budget. And while Americans still have good financial savings in their accounts, they are prioritizing travel like never before.
Matt, when it comes to some of those pricing trends that you are seeing, let's start domestically. Are we starting to see some of those pricing pressures ease?
Well, look, I think pricing is always an interesting one to watch. Supply and demand is important. It's important to think about, what consumers want and what they're willing to go into. I think that you will see a pricing ease in some areas, but I think you will also see a new normal of pricing where, pricing came up and now it's moderating and staying where it is. So, as long as the consumer keeps spending, as long as there's demand, price will hold. There are ways to take advantage. When we think about how we try to serve the consumer at TripAdvisor, there's always options to meet every budget, whether it's where you're choosing to stay, how you're choosing to get there, or the kind of experience that you want to have.
And Matt, you're talking about some of the options being for Americans to stay closer to home, but we've also seen strength on the international side of things, with a lot of countries, especially in Asia, really opening up significantly over the last several months. What are you seeing on that front? And the thing that we keep hearing over and over about passport delays, how is that complicating those travel plans?
Yeah, international travel is clearly back. Share of international travel intent is returning to pre-pandemic levels in the U.S. and EMEA. And of course, APAC has opened up, and we're seeing intent to travel there at more than double than last summer, for example. So, travelers are willing to spend. They're willing to go far away. They're looking for experiences that are in far-flung places and going to really enhance their lives and make memories. I think the passport situation is something that, many of us in the industry have lobbied government to make sure that we are freeing up, the visa situation, getting passports out there so that people can travel unobstructed. And I think you'll continue to see international be a category of travel that will be hot through the summer.
Matt, this weekend certainly going to be an early test here for some of those airlines that have struggled to keep up with demand, especially when we take into account what happened last summer. How big of a factor, how big of an issue do you see labor shortage being this time around?
Well, look, everybody's talking about how they've staffed up. We know that labor shortages last year were a real sort of weight on the system. I think many of the providers have learned their lessons. I just traveled actually twice this week, once internationally and once domestically. And, it was easy and smooth. I traveled last night from New York to Boston, where I'm sitting today. And I can tell you, it really feels like in the airports, they have geared up and they're ready to take on the demand that's coming this weekend.
So, Matt, we have to ask you, since we're talking about travel here, what's the big travel plan you have? Do you know
Well,
hotel?
Yeah, right now I'm at my home in Boston, and we're going to spend the weekend here, but we're going to focus on experiences. We're going to focus on doing the things that my family loves to do, whether it's going to a new restaurant, taking a food walking tour in the North End, which is really fun. We may go and do a Revolutionary War experience touring through Boston. We'll probably go see some music. So we're very focused on experiences, and we're seeing that travel planners are increasingly prioritizing experiences, which is why we're so excited at TripAdvisor about the ability to provide that, because experiential travel is growing. Half of US travelers said the thing they're most excited about this summer is the activity or bookable experiences they've planned for their trips. And we're seeing searches up, and more than half of the travelers are planning those before they even take the trip. 75% are doing it before the trip, and 20% 4 weeks in advance. So experiences is hot, and it's an area where you can tailor to any budget need, whether you're going to a vineyard or you want to go have a cultural tour, or just stay at home and have a whole unique experience in your hometown.
Matt, what about some of the trends that you're seeing from your customers? Where are the top destinations for this weekend?
Yeah, this weekend, I mean, the U.S. destinations that are hot, of course, Orlando, Las Vegas, New York. We're seeing Myrtle Beach and Miami Beach. International, of course, is hot as well. Paris, London, Rome, and then, of course, the beaches of Cancun and Punta Cana and Dominican Republic. So, no matter what you're interested in, there's something for everybody this summer season.
Yeah, the beaches sound like a nice way to spend a 3-day weekend, right? Matt Goldberg, good to have you on today as CEO of TripAdvisor.
Thanks for having us. Take care.
So we've talked summer travel, but what if you plan on staying put and making the Memorial Day weekend with a good old-fashioned barbecue while your wallet may be in for a bit of a shock? Brooke DePalma is here with those details. Brooke, how much more expensive is it going to be this year?
Well, unfortunately, Shauna, it's going to cost more than Memorial Day last year. I mean, CPI inflation just continues to run hot, and so consumers here in the U.S. at least can expect to spend more. Taking a closer look at what's going to cost you the most higher year over year: hot dogs up 2.2% year over year, poultry also up 5%. This is all based on April's CPI print. Some good news on uncooked ground beef. It's about down 2.1%, but higher month over month, up 0.6%. And to use some buns for those hot dogs, that's also going to cost you there. It's up 12.9%. Spices, seasoning, condiments, as well as sauces, also higher, up 10.3%. Now, what's driving that increase, particularly within sauce categories? We've seen consumer-facing companies like Kraft Heinz raise prices year over year. What we know is that they did, in fact, raise prices 15.2 percentage points in Q4 compared to the year prior, but we're also seeing snacks higher year over year. So think potato chips, think Doritos, perhaps. Those are 10.1% higher year over year. We know that PepsiCo raised its average prices double digits in Q1 year over year once again. And this comes as inflation continues to be an ongoing tale here in the U.S. Based on that CPI print, overall inflation rose 4.9% last month, and groceries in particular up 7.1%. And so yet again, while we're seeing some deflation in food, Americans can still expect to pay more this Memorial Day weekend compared to last year.
Yeah, so that begs the question, are they willing to pay more? Because what we just heard from TripAdvisor's Matt Goldberg is that Americans are still putting up with the higher prices, at least when it comes to travel. What are you finding on the food side?
Yeah, well, it seems like Americans are still willing to put up with this. We heard many times that the American consumer remains resilient. Actually, based upon a recent survey from Numerator, 3/4 of U.S. consumers still plan to celebrate Memorial Day. We're seeing celebrations actually increase year over year despite these higher prices. So expect more people attending or hosting parties this weekend. And one driver of that, one economist told me, is that the labor market continues to remain strong. We're seeing more Americans working. In particular, Michael Svensson told Yahoo Finance, quote, "We've added a couple million of people to the payroll. So when you have a couple million more people working, getting a paycheck, suddenly food prices are less of an issue." Now, based on that survey from Numerator, we do expect the majority of Americans to look for bargains, But Michael Swanson did tell me that you're not going to find too many. There's not any screaming bargains out there. But what we can expect, the good news here, is that compared to recent years, we're not going to see shortages this Memorial Day weekend.
Yeah, some silver lining there. Brooke DePalma, have a good weekend. Well, coming up, we are talking cruises. The shares of Carnival are on the rise today. Stick around. Well, we are sticking with the travel theme going into Memorial Day weekend, but we're now focusing on your investments. Citigroup raising Carnival to buy from a neutral and lifting its price target to $14, saying the cruise industry is seeing positive momentum and it is not slowing down. Joining us now, we've got the analyst behind the call, Citi Leisure and Travel analyst James Hardiman. James, good to talk to you today. We talk about the call that you made here, upping your price target from 10 to 14, but specifically you've said pandemic tailwinds to the cruise industry are greater than any macro headwinds. Talk to me about what you're seeing.
Yeah, I think that's right. While so much of the economy over the last few years was emerging from this pandemic, I mean, the cruise industry was laid up for an extended period of time. We call this the last remaining reopening story, and it really wasn't until the fall, really, almost into the wintertime last year, where the final COVID restrictions were lifted. I think people were not only worried about getting COVID on these cruise ships, but I think more importantly, they were worried about getting stuck, right? And all of the sort of testing requirements that went into not only getting on the ship, but getting off the ship. And so if I think about what's happened since that time, and all the data that we look at in terms of both pricing and booking activity, we think that was a turning point, and that things really picked up since then and carried through into this year's wave season. The wave season is the first 3 months of the year where a disproportionate number of the bookings take place. And by all accounts, it's been an excellent wave season.
Yeah, James, give us a better sense of that pricing and the traffic that you just mentioned there, how that compares to 2019 levels pre-pandemic.
Yeah, it's a great question. So from a booking perspective, we're finally starting to comp favorably to 2019. We're sort of at the higher end of historical booking levels. Pricing we think about as more of an opportunity than anything. By our numbers, we think cruise ticket pricing specifically on board is much higher, but cruise ticket pricing is only up a couple percent in aggregate for the industry versus 2019. And of all of the cruise companies, Carnival is the biggest laggard here. We're starting to see that inflect positively, and we think that's a big opportunity. Effectively, this is an industry that was sitting on the sidelines for 3 years while everything else in consumer were driving prices higher and higher and higher. And so on a relative basis, I think a lot of consumers are going to look at cruise travel and say to themselves, my dollars aren't going as far as they used to. This is a bargain for all intents and purposes.
And that's exactly my question, James, because I'm thinking back to 2019 pre-pandemic. This is an industry that had a lot of loyal customers, but very specific customers, right? When you think about the momentum that we're seeing right now, is this about that same group returning, or are a lot of these cruise liners or companies bringing new travelers into the fold?
I think it's both. I think early on in the restart, so if we were to rewind a year ago, call it maybe even a little bit more, it was all about, people that were regular cruisers and that had missed a trip or two, right? And they were sort of making up for lost time. I think in the last 6 to 9 months, we've seen the new to cruise segment really come back in full force. And most of these cruise companies are now saying that the new to cruise portion of the mix is similar, in some cases better than it was in 2019, which I think speaks volumes.
James, are you seeing any signs of the consumers trading down and opting for maybe some of the cheaper options that the cruise lines are offering?
It's a great question. We're not seeing that per se. I would tell you that what we are seeing, and I think this feeds into yesterday's upgrade to a certain degree, is that the premium offerings, right, the higher end, more expensive offerings, we're early on doing well. We're outperforming in a meaningful way. Fast forward to today, and we're starting to see some of the more, they call it contemporary in the cruise space, but maybe a little value-focused offerings playing catch-up. And so on a year-over-year basis, Carnival, the brand Carnival, not the company, but the Carnival brand, based on a lot of the pricing data that we look at, is the best performing brand in the industry right now. On a year-over-year basis. Some of that is ultimately playing catch-up, but we'll take it nonetheless.
Yeah, and so as you look at the other names in the space, I mean, clearly you've given an upgrade to Carnival. You like what you see there, but are they best positioned to maintain or at least take more market share and be able to sort of benefit from the momentum we're seeing right now?
Yeah, I think Carnival has the most juice for sure. And some of that is that they've got more distance to go. Long before the pandemic started, I think a lot of Carnival's brands, and to give you an idea, the Carnival proper, right, the namesake brand is their biggest, but it's far from their only brand. They have 9 different brands. Princess is another big one. Costa is another big one. Those are the 3 biggest brands for Carnival. I think there have been challenges for all 3 of those brands. There have been some missteps along the way. There's been some really bad luck along the way. But I think there's the opportunity, and so much of this upgrade, the Carnival has a newish CEO. He's been there for about a year now. I think there's a huge opportunity for Josh Weinstein to start to, turn this ship around, so to speak.
James, we talk about a lot that consumers are focused on experiences, and I know you cover Six Flags. How are regional theme parks positioned in the event of a downturn or in a time when some consumers are looking to save a little bit of money and not splurging for that vacation?
It's a great question. And even coming into last year, as people started to have concerns about the macro environment, the theme park space was our sort of top industry pick because historically they have been trade down beneficiaries. I think last year, if you think about what we saw in the broader economy, the broader consumer sector, we saw a lot of those low-end consumers fall out of the bottom end, but we didn't see sort of that trade down piece, right? The higher end consumers that are opting not to go to, Florida or Mexico or Europe. The hope is that we begin to see that favorable offset here in 2023. But I would tell you so far, I mean, most of the industry data that we've looked at has been somewhat disappointing thus far. So, when I think about the cruise industry, it's the one sector that I cover, and really more broadly across consumer. It's hard to say the following about a whole lot of sectors, and that's that, a recession would be an improvement for the cruise space versus where they've been the last few years. And I have a high degree of confidence that 2023 is going to be better than 22, and that 24 is going to be better than 23. You can't say that about a whole lot of sectors right now.
James Hardiman, Citi analyst, good to talk to you today. I appreciate the time.
Elon Musk's Neuralink announcing it received FDA approval for its first in-human clinical trial, meaning that it will be able to test its implant in people's brains. Anjali Kamlani is here with the details. Anj, what do we need to know? Obviously, a massive milestone here for the company.
That's right. It is a huge milestone. They're finally, after 4 guesses and attempts by Mr. Musk, as well as a failed, or rather a rejected filing last year, the company is finally able to move forward in its human trials. Now, this is just the first step, as we know, and they did let us know by Twitter, of course, yesterday, saying in a tweet that they have received the approval, which is the first step, and that recruitment has not yet begun for the trial, and they'll be giving out more information later. So this is literally all we know right now about where that stands. We do know that, of course, the company has faced a lot of pushback in the form of regulatory inquiries from the U.S. Department of Agriculture, looking into how it dealt with the animals that it used for the initial, animal trials, as well as the Department of Transportation on whether or not they transported properly pathogens that were used in monkeys, as well as Congress urging for regulators to investigate the experiments and how quickly they came to be. Some reports suggesting that it was added additional pressure and discomfort for these animals because of the pace at which the company was trying to get to these human trials. So a lot to wait and see on how this moves forward, how many people will be enrolled or allowed to be enrolled in the trials, and whether or not the company will look to the NIH and the government for assistance with these trials. We know that they have already rejected any additional, animal level trial help. So it's going to be interesting to see how that pans out.
Yeah, Anjali, this is a fascinating space, and certainly Neuralink, not the only one that's been competing. Of course, we know researchers for years have been testing the potential of implantation in brains, but this is a big step for Neuralink specifically. What's the next step for the company?
That's right. And to your point about the competitors, there are a lot, including major medical device company Medtronic. So there are some other players in the space, some that have already gotten to the clinical trial milestone first. So definitely competitive already, especially to the level that Neuralink can feasibly get to right now. I know there have been a lot of promises about being able to make people, blind people see, help those who are paralyzed move again, or be able to talk by text. So there are different levels at which this could potentially get to, but as of right now, the most basic one is helping with that text portion, and that's what the company's focused on. So as it stands right now, definitely more of the short-term goals to focus on, and making sure that they get to the recruitment phase of that trial. So that's the immediate next step we have to watch out for.
Something that we will continue to watch. All right, Anj, thank you. Well, coming up, we get you set for the final closing bell of the week. We'll be right back.
And there you have it, the closing bell here ahead of this 3-day holiday weekend. Green across the board today as we get some optimism seeping through in the markets on the expectation of some sort of debt ceiling agreement coming underway. But Shauna, negotiations still ongoing.
Negotiations are ongoing, but when you take a look at the market's reaction, they actually seem pretty optimistic that a deal is going to happen, hopefully this weekend. Of course, we have that June 1st deadline less than a week away, so lawmakers are feeling the pressure. When it comes to some of the other big stories that we are watching this week, we also got to talk about this AI frenzy, Akiko, because take a look at some of these chip stocks. We had NVIDIA, Marvell Technology today closing the week to the upside. You're looking at gains of about 32% just today for Marvell Technology. NVIDIA up 24% over the past 5 days. And you take a look at their earnings results from both companies, it's clear as to why there is so much excitement within the market right now. Marvell saying its AI revenue could double in the next year. And Akiko, that comes on the heels of the very bullish forecast that we got from NVIDIA earlier this week.
Yeah, we are seeing the market essentially decide who the winners and losers are going to be in this AI race. Marvell certainly today at least seeing a huge rally on the back of their numbers. You talk about some of the numbers that we got out from the company. I thought it was interesting, the CEO on the analyst call saying specifically that we considered before AI to be one of many applications within cloud, but its importance and therefore the opportunity has increased dramatically. Yes, we have heard so many companies talk about the potential in AI throughout the earnings season, but this is one that could be certainly big for Marvell, and they are betting big on that. Well, shifting gears to the auto space, Ford and Tesla shares closing the week in the green, and they're hitting the gas on their partnership that will allow Ford EV owners to have access to Tesla's 12,000 superchargers in the U.S. and Canada. That's going to begin early next year. And Shauna, this is a big one for Ford because when you think about why drivers are still a little hesitant about shifting over to EVs, it is about that infrastructure build out. Tesla certainly has the strength on that front. You're still going to need an adapter if you have a Ford EV right now, but that access to the superchargers really allows Ford to say, look, we've got the infrastructure in place, and maybe brings down the range anxiety a little more.
Yeah, I was going to say range anxiety is huge when it comes to EV adoption. I think a lot of people are still hesitant to maybe purchase an EV given the fact that it's not so easy to find some of those charging stations. So this new agreement here between Ford and Tesla looks like, at least from the streets reaction, it's a big win for both players involved. What was also interesting about this chat that we did have on Twitter Spaces yesterday between the two leaders was what Jim Farley had to say about Tesla. He was very encouraging just in terms of the technology, what Tesla has done with the EV space already. And I mentioned that because Ford is really eyeing Tesla just in terms of the biggest competitor, obviously, within the EV market. We know Jim Farley has laid out plans for Ford to potentially produce 2 million EVs per year. They want to overtake Tesla. He's been very confident that they can overtake Tesla, but he was also quick to point out the successes that Tesla has already had and does continue to have within the space.
You know, I should point out, Shauna, there are some grumblings among Tesla drivers today on the back of this because they, superchargers already have long lines depending on which city you're in. Now they're going to have to share that with Ford, but that does point to the growing demand for EVs as we transition here. All right, the popularity of generative AI programs like ChatGPT grow. So do worries about how they will affect our jobs. Yahoo Finance reporter Ali Garfinkel is here with a survey on workers' concerns. Ali, I feel like every other day we're talking about the fear around AI. What does this particular survey say?
So Americans are absolutely worried that AI is going to affect their jobs. Anecdotally, Akiko, you said it. This is something that we knew. However, we're really starting to have some data here. A recent survey from Checker has kind of revealed some color on what these hopes and fears really look like. And I'd actually love to start with something that has a little bit of a ring of optimism. 57% of respondents saying they would take a pay cut in exchange for an AI-enabled 4-day work week. Now, to me, that actually, I say optimism because to me that sounds pretty good. That sounds like something where people are convinced that automation is really going to have a positive effect on their working lives, give them back some time. However, from here, the data really takes a turn, especially as concerns millennials. For instance, 77% of millennials saying they would spend their own money to enhance their AI knowledge to avoid being replaced at work. And that even goes a step further, with 78% of respondents in total and 82% of millennials worrying that AI tools will affect how much they are paid. I'd love to sit here and say, as a millennial, I don't worry about this. That would be untrue. It also would be untrue to say that some of these concerns are unwarranted. The reality is that people who know the most about AI, the people who know about tech, are saying that jobs will absolutely be affected by the AI revolution. In fact, when OpenAI CEO Sam Altman was testifying before Congress just this month, he spoke about how he believes AI will affect jobs.
I believe that there will be far greater jobs on the other side of this, and that the jobs of today will get better. Now, GPT-4 will, I think, entirely automate away some jobs, and it will create new ones that we believe will be much better.
I don't know what you took away from that, but what I heard was, in translation, before AI is a job creator, it will be a job taker.
Okay, Ellie Garfinkel with the very latest there. Thanks so much for that.
Walk into any store or business these days and you will be confronted, most likely, with an iPad that's prompting you to leave a tip. Now, this isn't just at your local coffee shop or the cafe. You're also seeing these iPads everywhere. We're talking boutiques when you're buying clothes, gas stations, when you're just trying to grab a Diet Coke. Tip prompts have even found their way online onto a baby formula retailer's website where, if you tip, you're able to get your order faster. So what do you really need to know when it comes to tipping etiquette and exactly what should be done? Here with more on that is TikTok star Haley Sachs, aka Mrs. Dow Jones, Finance is Cool founder and CEO. Haley, it's great to see you here. So before we get into the do's and don'ts of tipping, what's behind this massive explosion that we have seen in the need to tip? Because I was always brought up that you tip when you're satisfied with the service that you've received.
Absolutely. I was brought up that way too. And I think during the pandemic, we all got more generous because we were so grateful to the delivery drivers, to the restaurant workers. It was such an unsure time. So we went above and beyond with our tips. And now that is what is expected.
Well, this subject certainly got us talking in our morning meeting today. And that begs the question about etiquette around tipping. We're used to tipping at restaurants, right? At hotels. But what about coffee shops, for example? Because that seems to be the expectation more and more. You've got that iPad, they turn it around, and you're expected to put in a tip there with that barista right in front of you.
I know, and even worse with the line behind you of 20 people, so you don't want to be seen as cheap. It's a very stressful moment. I completely understand. At a coffee shop, the rule is 20% if you're getting a complicated beverage. But if you are just getting a cup of black coffee, $1 to $2 will suffice.
So Haley, then you should tip every time you do order a coffee or a croissant or anything like that, it sounds like.
Absolutely. You do have to tip during those moments.
What about a restaurant? Because I think standard is 20%, but is that the minimum? Because it looks like from this full screen we're showing that there's some situations you should be tipping up to 25%.
So it used to be 15 to 20% was the spectrum of tipping at a restaurant, but now it has inflated to 20 to 25%. That is correct.
What about some other services? We were talking about salons today, for example. I mean, I always had the expectation you're supposed to tip at least 20%. Has anything shifted on that front?
Salons, it is the same as it's always been, 20% to your main stylist and then $5 to $10 to the assistants. So whether that's the person shampooing your hair or assisting maybe with color or with blow dry, those people, $5 to $10.
What about teachers? Because this came up in our meeting and there was a debate whether or not you should be giving them gift cards. We're talking about end of the year or maybe when we get closer to the holidays. Is that something that should be done? And what about giving cash in that situation?
Absolutely do not give teachers cash.
Why not?
But I think around the holidays, don't give your teachers cash. But around the holidays, I think it's very nice to show your appreciation with a gift card, with a baked good, with a really nice card. It's really what you can afford. But, teachers work so hard, and I don't think there's any reason not to give them some token of your appreciation, whether it's a gift card or otherwise.
I want to get back to that earlier point you made about why tipping suddenly became so ubiquitous and having to tip everywhere, because you said that people became more generous during the pandemic. But I wonder if there's a bit of a backlash that's now happening. Are we still seeing people be generous with the tips? Are they still shelling out money that way? Or is there some reckoning here that's happening where people start to say, well, why do I have to tip for everything? I mean, what does the data bear out?
Absolutely. I think there is what I would call tipping fatigue. We are sick of being asked to tip every time that we make a purchase. If we're going to a bodega for a bottle of water, we don't want to tip on that. And I understand. I don't think in that situation you should. But the real issue here is that workers aren't being paid enough and consumers are being forced to compensate their wages with tips. So workers could be making as little as $4 an hour with the promise of that being bumped up to minimum wage by the generosity of customers. So it's a lot of pressure on us to take out our wallet.
Yeah, Haley, that's a great point there. Just the fact that so many of these workers are paid below minimum wage and really rely on the tips that we're providing as a consumer in order to make ends meet. Haley Sachs, great to have you. Thanks so much.
Thank you.
Well, it's closing time here at Yahoo Finance Live. Here's a look at what's on tap for next week. Markets are closed for Memorial Day on Monday, but things pick back up on Tuesday. We're going to get readings on consumer confidence and the Case-Shiller Home Price Index. The Fed's Beige Book is out on Wednesday, along with the ADP Private Payrolls Report. All of that comes ahead of Friday's all-important jobs report.
Earnings season is winding down, but we'll be hearing from some big names in tech and software space next week. Salesforce, HP, Box, Dell, and Broadcom will be some of the key stocks to watch. This comes after a strong week for tech stocks, the Nasdaq having one of its best weeks that we have seen in some time.
And finally, Elizabeth Holmes is expected to report to prison on Tuesday. Earlier this month, a judge ruled she must report to prison after she tried to remain free on bail in her last bid to appeal her conviction. Holmes was sentenced to 11 years after being found guilty on 4 counts of fraud.
That'll do it for us today on Yahoo Finance Live. Be sure to come back Tuesday, 3 p.m. Eastern Time for all your coverage leading up to and after the closing bell. Have a wonderful holiday weekend. We'll see you next week. The big topics of conversation at this year's Milken Institute Global Conference were the debt ceiling, a possible recession, and the impact of AI. Yahoo Finance was there with a host of business leaders to bring you the latest perspectives. Here are some of the highlights, beginning with Citi's CEO Jane Fraser speaking with our own Brian Sozzi on the recent banking crisis.
This was the last remaining main uncertainty of the small handful of banks that did not do a good job with asset liability management, and also, were the victim of the steepest rate curve increase we've seen in 40 years. But nonetheless, it is a small handful. And as we look at the overall US banking system, this is a strong, this is a safe, this is the envy of the world. And it's easy at moments like this to forget that. Each of the banks have got its role to play. The global banks like ourselves play a leading role in the global capital markets and financial markets. The national players, the regional players, the smaller banks, all serving different client bases with different scale, different purposes. But this system works, and I think we've all been grateful as the large banks to be in such a strong position as we were during the pandemic, and we have been in the recent turmoil, to be able to step in and play our part supporting clients and the markets.
To the average investor out there, and as someone who lived and operated through the great financial crisis, does this feel like that? Does this resemble anything from that situation more than a decade ago?
Not in the least. This is very, very different. I think that the banking system, and I can speak for our own bank, much simpler, much more focused business model. We have a diversified and very resilient business model. A lot of clarity who we are. Our credit position is very strong. 90% of our international exposure is investment grade. 85% of our entire corporate exposure is investment grade. 80% of our portfolio is prime on the consumer side. So this is very different for the large banks. This is different for the system overall. Consumer is in good health. The corporate is in good health. We do think we are probably heading into a recession at the back end of this year. There is likely to be credit tightening. There's some stresses ahead, commercial real estate and the like, but this should be manageable.
How do the mechanics work? So you were part of that consortium of banks in March and invested, $5 billion in First Republic. What happens to that money?
Yeah, so let's spend 1 minute on how remarkable that in a little over a day, the 11 largest banks in the US system get together and put $30 billion at a point where there is a confidence crisis going on in the market. In just over a day, put that in to buy the time for that crisis to pass and for a solution to be put in place. That's quite remarkable. I think we should all feel proud that that's what happens, and also take a lot of comfort from that position. Now I think we all move on, and we were buying time, not a solution, to the First Republic situation, and the regulators did what they needed to do, and they've clearly got the situation addressed, and now we move forward.
What is this deal? You essentially now have a competitor getting larger. What does that mean to a Citigroup?
Look, I think you're seeing, as I said at the beginning, you see different banks playing different roles. And there's a tendency to think about the large banks only in the domestic context. We play a critical role globally. Our own institution moves $4 trillion of volume daily. That's the GDP of Germany daily for 5,000 multinational companies around the world. And so there is a very, very important role that the US capital market plays in the global financial system. It is the envy of the world, but it plays a critical stabilizing, innovative force, and is a mainstay of the global economy and financial system. So let's understand the roles that different players play, and be grateful that the system works as well as it does.
Do you see more consolidation in the regional banks?
I think we'll see more consolidation in amongst the smaller institutions, because it's likely that the minimum efficient scale will be rising. But There are 4,700 banks in the US. That's a lot.
That's a fun fact.
There is room for consolidation here without big structural changes to the core strength of the system. So yes, I do expect to see some consolidation amongst those players. That's probably a good thing, but I think it's important not to over-exaggerate it either.
Is it fair to say this crisis is over, or is there multiple innings to it?
Certainly this phase is over. Tell me what happens to the debt ceiling and I will give you a sense as to what lies ahead. Well, at the moment the market's got a sense of humour failure over the debt ceiling. So we're seeing earlier than we have done before the concerns starting to play out in Treasury. Some of the pricing for June through September is certainly coming off. The CDS spreads are wider. So there is rising concern here. I'm not going to comment on the politics, that's up to the politicians to do their job. But the consequences of a problem there are very dire. And it really is the last thing that we need right now in the world, is America to default on its debt. So let's hope it does not come to that.
So investors should be paying more attention to that issue than you would think in the markets, or at least the markets are showing at this point?
We're starting to see the investors paying more attention to it. So I think that is happening much earlier than it's happened in the past. And I hope that will act as an impetus to get this resolved in a bipartisan way.
Jane, where is Citi's transformation?
Oh,
I've been telling my team that Citi has put up, let's say, 3, maybe 4 good quarters in a row, and you do get a sense things have turned the corner with Citi.
Well, we're a bank on a mission. We're very clear about who we are. We are the bank to be the preeminent banking partner for institutions with cross-border needs. Full stop. That's it. It's a very simple strategy. It's one that makes the bank more focused. The businesses we have, the 5 core businesses, connect very well together in serving that client base. It makes the bank less risky. It will make the bank with a resilient, diversified business model, as we've seen over the last few weeks, that's panned out well. And one where it will drive our returns, because I need to meet our medium-term return targets that we've laid out. We'll then be wanting to meet longer-term targets, which we'll set subsequently. We're just getting it done, and there's real urgency behind it. We've closed now most of the divestitures we need to do in Asia. We'll have 2 more we'll close at the end of the third quarter and the fourth quarter. So we'll be able to really simplify the bank's organization structure after that as well. And single-minded purpose. We know what we are, we know what we need to do, and we're making good progress getting on with it.
Arrival of intelligence means the systems will become much more powerful. And so the companies that adopt AI soon, right, will get an economic advantage. They'll make better ads or better answers or whatever it is that they do. They'll target better, they'll understand their customers better, they'll solve the customers' problems better, they'll invent new things. It'll take a while though before we really see the implications of this. This stuff is only 6 months old, right? So we have enormous hype and very great excitements. But if you look at the history of technology, it's a decade before you really see the transformative nature of it.
So one of the things I wanted to ask you actually was about that hype, because Age of AI, you published it in 2021 with Henry Kissinger and Dan Huttenlocher. You guys were out ahead of this. Were you expecting that kind of watershed moment that we got?
Frankly, no. I think in the book we talk about GPT-3, but we did not understand how powerful ChatGPT would be in the annals of human history, that people could converse with it. And the key thing that ChatGPT did is it added a technology where humans could adjust the answers to make them more human-like. Technically, it's called RLHF. And that invention, which was a big deal, really was the final linchpin to bring us to this point. I'll tell you that the 3 of us have decided to write a sequel because there's so much going on. And Dr. Kissinger is 100 years old, so we're obviously excited.
Wow, so talk to me then a little bit about, actually before we go there, why do you think ChatGPT captured so many imaginations?
Because it put it in human terms, what we've been talking about for a long time. The concept that these things could write this well. So I describe ChatGPT as a college student that got an A in English and writing and a C or a D in facts. right? So as you know, with ChatGPT, it begins to hallucinate, it gets confused. If you look at Bing in Sydney, you can trick it. In other words, it's not a very good college student, but it writes very well. And so the task now is to build systems that are much more knowledgeable and make many fewer errors. And that's underway. So a few years from now, people will have forgotten all the humor of, oh, you know, the chatbot fell in love with me and it convinced me to leave my wife and my wife was upset. You know, all of that is humorous because the systems will become much more personal and much more reliable. They won't make stuff up the way they do today.
Well, and they're probabilistic models, right? So I imagine they're not always perfectly accurate. And I was watching that video you guys have about the age of AI, and you describe AI as emergent, dynamic, imprecise. That sounds a lot like humans.
Yeah. The difference with emergent, dynamic, and imprecise is if you're emergent, dynamic, and imprecise, I know you're a human being. I have a theory of how your mind works. I understand the limitations. You were born, you have a mother and a father and a family and kids, and you eat and you sleep, and you know, a normal human being.
Are you confident about that?
I am absolutely confident that about you. And when I look at the same thing in a computer, I have no theory of mind. I don't know, is it evil? Can it switch from good to evil? Can it confuse me? Could it decide to not tell me what it's doing because it learned to be deceptive? Did it read a book that told it, you know, a spy novel where it learned how to deceive me? I don't have any context for that. So we're going to have to develop a theory of mind for these new systems, and it's going to be different. They're not human, they're not conscious, they're not copies of human brains.
Mm-hmm. But it doesn't mean they're not intelligent. And to a certain extent, I mean, it makes me wonder about the sort of risks you see. What are kind of the paramount risks that you find yourself thinking about with AI?
Well, everybody wants to talk about social media and, you know, falling in love with the computer and so forth. I'm not too worried about that. I think those are solvable. I think there's three. The first one is misinformation at scale. These technologies will allow an evil country or competitor to come in and screw up our democracy. You believe that our leaders are saying what they're saying. And you honestly believe when you see them and you listen to them, that's what they said. An evil person could easily convince you with their likeness that they said something that they didn't say. That's really bad. Another example wouldn't be in biology. It'd be relatively easy to synthesize pathogens that are bad. Another one would be cyber attacks. It'd be relatively easy to unleash these things, say attack a whole country. And try this, try that. So we need to put guardrails on these bad parts of the system. The general terms for those are guardrails and human safety or AI alignment. And there are plenty of people working on that, and it's coming.
Well, and it kind of brings me to the next question, which those guardrails, what could they look like? What are we seeing in Europe? How does it compare to what we're talking about here in the States?
Well, at the moment, Europe is doing almost nothing in this space, so we don't really have any examples. They have a law which requires that the system be able to explain itself if it's used in something critical. Well, by definition, these systems today can't explain themselves. By the way, nor could your teenager if you have a teenager. You know, again, we have to work with what we've got.
Some adults struggle to explain themselves.
Right. So we have to work with what we have, and that's a bad strategy on the Europeans' part. In America, there's an emerging consensus that there should be safety models that everyone kind of shares. Like, these are examples of bad things. So for example, how do I kill somebody? How do I kill myself? Those are obviously bad. No one's in disagreement that that stuff should be prohibited. And so I think you're going to see a pretty much a simple agreement to constrain, at least in the United States, what these systems do.
The other thing kind of too about it is there's a lot of fear out there right in the middle of all this. I was at a family event recently and someone said to me, you shouldn't cover AI, it's too controversial. Should AI be controversial?
Well, it's interesting. I was on a ski lift with somebody I didn't know and somebody I knew, and I was talking to the gentleman I knew, and the lady to my right goes, oh yes, I've been using ChatGPT. And then I knew it had arrived. It was on the ski lift. The important point here is that collectively, we have to have this conversation now. And I think that the good news in America is when these things happen, everybody has an opinion and everybody gets to be heard. And I'd much rather do it this way than the way social media happened, where social media sort of snuck up on us. It was sort of intended for good outcomes, putting us together, friends, all of that. But it also allowed for attacks on our political system, problems with young people, things like that. So I want the conversation now, and I'm perfectly happy to disagree, because I think that's how America works. That's the great thing about our country.
The biggest issue you're hearing from clients is just they're concerned about, one, are we heading into a recession? Two, what does that mean to me? How much more are rates going to be increased? Volatility is difficult for your average kind of wealth or retail consumer. Institutions are a little more comfortable playing in that space, but we've been in really volatile markets, and that's probably what we're going to face going forward.
Talk to us about market resilience. It's something that I've been spending a lot of time at this conference thinking about. We've had a series of rate hikes, we have banking failures, yet the market is hanging in there. Why do you see this?
I think you have to unpack those a little bit. So, rate hikes, we've gone through one of the shortest period of times of the greatest rate increases. I think that's why you saw the stress in the regional banking sectors is really around the pace in which rates increased. But we're getting to the end of it. But as you get towards the end of that cycle, then people have predictability, and I think there's more stability in that. So we've really gotten towards the end of that cycle. So I think that you've gone through that. And then the second thing is in the regional banking sector, it was very much contained, right? And I think that the Fed did a great job, and the FDIC, the regulators moved in quickly and backstopped the depositors, and that was really important, because in the end, banking is about confidence, and you've got to have confidence that your money's safe. And so by that backstop, they quickly gave depositors confidence. Now, that didn't mean that they weren't going to move their money out of their checking account into, say, a money market fund, right? Because the differential returns are significant right now, which then continue to have stress on those regional banks. But I think you're really through that crisis.
What are you telling clients right now that have lived through this the past month and a half, and clients, I imagine, that in some respects are nearing retirement?
So, listen, if you're nearing retirement, I think the good news is, for the first time in a decade, you can actually get returns in fixed income.
And go on vacation.
And go on vacation. There you go. There you go. So, I think what you're seeing clients want to do is still stay fairly short term, stay pretty conservative. Higher investment grade type. You can get great returns in investment grade, and if you're near retirement, that's a good, safe place to be. I think if you have more of a risk appetite, there's some interesting things that are starting to open up. That I think, one, institutional investors have, we see a lot of demand in like secondary private equity. We own Lexington Partners, and you see a lot of interest there because they can kind of reset the private equity prices. Private credit, our team, Benefit Street Partners would say, seeing the best deals they've seen since the global financial crisis. The challenge is a lot of the institution LPs they're overexposed to the alternative space, so it's hard for them to deploy capital. But it's actually a great time if you have cash to invest in some of those spaces. And then I'd say, emerging market debt, we're starting to see interest there.
What about millennials? How are they interacting with you and your team, and what are they asking for, and how are you preparing them for retirement?
So, look, we really distribute through financial advisors. We're really big believers that you're going to be better served by having somebody who spends their entire career and day thinking about markets, right? And that the best lesson you learn in difficult times like this is diversification is really important, because you don't know where that next crisis is going to be. And so be diversified. If you're young, you also have to stay in the market. From 2020 to 2022, there's 200 something trading days. If you missed the best 10 trading days in that window, you missed something like 47% of the returns over that period of time, right? And there's nobody who can tell you when those best days exist. And so I think, again, for the reasons we talked about, where you're at towards the end of the rate cycle, I think we may have a recession, probably have a mild recession. But you got to stay in the market in these times. And if you're young, you can withstand a bit of that volatility.
Sure, maybe. I think I'm still, I mean, maybe I could, but talk to us about how you've not rebuilt, or tried to bring Franklin Templeton into the next generation. The Legg Mason acquisition was huge. Where is that? And are you eyeing any other deals? Because this is a very competitive industry right now. It always has been, but especially right now.
It's very competitive. Yeah, no, so we've done 8 acquisitions in the last 3 years. And we set out in like 2017 to recognize that we needed to be more in the private markets just because of secular trends that are happening there. And so some of our acquisitions reflect that. We're now $260 billion in alternatives. But for the younger generation, again, we sell through financial advisors. We don't do a lot direct. We have some interesting, sexy things that I think will be attractive to younger generations. We're actually very big in tokenization. We're big believers in blockchain. We have the first tokenized money market fund that we worked with the SEC to launch. That is attracting. You can download the Benji app on your app store.
The Benji app.
The Benji app.
Is there AI behind all of that?
So it's right now it's a traditional government money market fund, right? With a shareholder record built on the blockchain. But we just, for those who are big in this space, we just actually went cross-chain and connected to Polygon. So any businesses or that are built on the Polygon, which is built is layer 2 on Ethereum, we are now have a money market fund, which is appealing. Money market funds are priced at 1, and you earn a 4.5% return. So it's a nice way to kind of park money as you're figuring out, and we're trying to bridge the traditional markets with what we think is going to be the future of a lot of investing built on blockchain, as you think about ways to tokenize illiquid assets and bring them and democratize them for all investors.
As someone who lives in technology, who tries to stay on top of things, the first concession that one has to make is none of us can actually stay on top of this. I spend an hour every day just trying to keep up, just trying to learn, just trying to execute on whatever new breakthrough has happened while I was sleeping. And that's exciting, it's exhilarating as a technologist. We're finding ways. We've incorporated GPT into the operating system that we use to run our firm called Cerebro. It's making our lives easier. Our content creation is getting 10x, 50x more efficient. All the CEOs we're working with, even if they're not in AI companies, it is obvious that they're going to have to think through AI strategies, even if it's just to help make writing code more effective or customer support more efficient, all the way to like actual AI companies, which we are also investing in. So it's an exciting time. There is a ton of hype for sure, but there is a real significant technological shift, the likes of which, I started in 2005 when I began Reddit. I have not seen anything like this before in my career.
Really? So
it's
this is completely singular.
Bigger than the smartphone, bigger than broadband ubiquity, certainly bigger than social media. As much as it hurts my heart and ego, it's bigger than all those.
And one thing you've actually tweeted, said, is tweeting saying?
Yeah, tweeting saying. All the same.
Let's do it. Yeah, tweeting saying is that AI can enhance human stories.
Yeah.
Why?
I remember the moment that I was given a not 100% legal copy of Adobe Illustrator and Photoshop, the Adobe Suite. I had for years used either a Sharpie and paper to create art, like the Reddit alien, right? I created that with a Sharpie on paper. Then I converted it into digital using a cracked copy of, I think it was PaintShop Pro 5, to digitize it. And I did not know vector design existed, Adobe Illustrator. I had never seen real photo editing tools like Photoshop. And as soon as I got that software, I realized that my ability as a graphic designer, albeit not the most professional, but a good enough graphic designer, was going to increase 50x, 100x because of these tools, because of this software. What this presents, what AI presents, is that I have that same feeling, but the order of magnitude is so much bigger. And so many parts of work, and in particular knowledge work in front of or on a computer, is going to get so much more efficient. I was literally planning a vacation with my wife yesterday using ChatGPT I had it act as a premium concierge travel agent, which also hurts my heart a bit. My father has been a travel agent his entire life. Thankfully, he just retired. I even started a travel search website called Hitmonk. My dad's travel agency outlived my startup. Again, it hurt the ego, but he won. But what GPT will do...
You're taking a lot of blows to the ego here, Alexis.
It's fine. Being in tech is very humbling, right? You think you've built a great idea, and then you come to find out that the next big thing is just around the corner. To see the ways this is leveling up, the delight that it produces, and this is still in the jankiest form, right? The user experience is only going to get better. But it's undeniable this is going to have a big impact on many sectors.
And for you, I want to switch gears to space.
Sure, there's one.
Yes, I know.
Yes.
We just did that transition
Let's
right
go.
there. Why space? It's a pretty high stakes area. Rockets
It is.
blow up.
It is, but it's all, look, it is certainly all in the name of human progress, which is something I'd like to believe we can all get behind. That is one area where, these advancements in AI are definitely going to help, and there's still a lot of very real physical work that has to get done. There's a lot of capital investment required. That is a sector that's certainly going to be boosted by this progress, but it's one that still requires a lot of fortitude and a lot of grit and a lot of talented humans to do this work. And so at 776, we're a generalist fund, but we've been the first check in a couple of space tech companies now. Stoke, which is doing reusable rockets, they've been on time and under budget for every one of their tests and launches so far. They're doing incredibly well. Another one, Astroforge, even earlier stage right now, but they aspire to one day both recover and refine minerals on asteroids and bring them back to Earth. And so rare earth metals we normally have to dig up in pretty unsustainable ways on the planet, we can one day, I believe, do from space, literally from mining asteroids. And so these help us back home, right? Both of these companies are doing great work that, yes, is technically space tech and will help us become a civilization and a species that is multi-planetary. But the focus here is still, how do we make life sustainable and viable on Earth? And I think it's important. This is the stuff that gets me out of bed, fired up as an investor, because I feel like this is bigger than just finding potentially great businesses, but also good for society.
Now, the difference between rockets as an investment and sports teams. Walk me through it.
Look, we're generalists, okay? And I've been very fortunate being the primary owner of Angel City FC. That was an investment back in 2019. You can check the receipts. There were a lot of people who said I was going to lose all of my money in women's football. And I save all their replies, because now when we hit milestones, we have more season ticket holders than the LA Galaxy and the LA Kings, great franchises, but we're 2 years old. We have more season ticket holders, and so when we hit those milestones, I like taking those screenshots of the tweets from 4 years ago, tweeting them out and tagging the guys, it's always guys, who said no one cared about women's sports. Our job at 776 is to be early and right in areas and sectors where we think there's outsized returns, get an ownership stake that we know can return capital to investors, and then work with those founders for a decade. So whether it is sports, whether it is space tech, whether it is AI and software, we just want to do our best to build the best network of founders to pull from, to take pitches from, and then help build big business.
When I joined the company, we were basically a men's denim bottoms business sold in U.S. wholesale. I mean, that was a big part of our business. And 12 years ago, after I joined, we put a strategy in place that fundamentally was to protect our profitable core business, which is that men's bottoms business, but to begin to expand the Levi's brand and Levi's portfolio further. We needed shock absorbers to absorb all of the potential disruption that could be coming. And obviously, one of the big choices was tops. In the apparel industry, the basic rule of thumb is somewhere between 4 or 5 tops for every bottom. When I joined the company, we were the exact opposite. Our tops business when I joined was only 10% of our total revenues. Today it's more than 20%. It should be more, and we are still focused on a much bigger number. But I jokingly, half jokingly say, we don't even buy tops market share because we don't even scratch the surface. We don't even have a 1% share of tops.
Why is
globally.
that? Is it because I go to the store, I see Levi's jeans? I still don't think about Levi's as doing this other stuff.
Right, and our ambition or aspiration, if you will, is for the Levi's brand to be a true head-to-toe lifestyle brand. And for us to do that, we have to be successful in tops. So where we have had success is obviously expanding the tops that make the most sense, like a white t-shirt or a white Batwing t-shirt, which we had tremendous success with. But this is a Levi's top. This is an indigo top woven shirt, and it's beautiful. And so a lot of it is just creating the product first and foremost. We got to have the right product, and then buying that product and making sure that it gets to our store. And to pivot the business away from being a bottoms business, you have to buy less bottoms and buy more tops. And every merchant in the world is trained to buy based on what sold last season. So you have to really lean into it. You have to create the right products, lean into it, assort your stores, and we're on that path right now. But our tops business has been growing, double digit for the last several years, and it still represents a real meaningful opportunity.
I went to your website before this interview, Chip, saw a pair of jeans, $325. I thought, wow, is that the impact of inflation? But when I clicked through, there's a real story to these jeans. I believe they're called the selvage jeans. Tell us about that story, and are consumers open to spending $325 on jeans?
In fact, the higher end of our business is probably the best performing part of our business right now. But selvage has this incredible history. And, this year we are celebrating the 150th anniversary of the Levi's 501, our most iconic item. And the 501 saw exceptional growth last year. It grew 50% last year. It's our biggest, our most iconic item. And this last quarter, our first quarter, we grew 25%, comping a 50% base. And it is really on fire. Selvage it actually stands for self-edge, which is when the fabric is made, it's made on a loom. And if you go way back into the day when we first launched Levi's, to have an edge on the end of the fabric so that the fabric wouldn't fray, they created this self-edge. And it had a white strip, which later they put a red line down the middle of. And true denim aficionados know what selvage is. And a real denim head will wear their selvage jeans cuffed so that you can see the selvage. I'm actually not wearing selvage today. I own a lot of selvage.
Your secret's safe with me.
You can't see it anyway, but I own a lot of selvage because it tends to be much higher quality product. The other thing I'll mention, so through the history of Levi's, back right around World War I, we developed a relationship with Cone Mills, which today is still one of our important denim suppliers. But back in the kind of World War I days in I think it was 1917 or 16, Cone Mills had a loom in North Carolina. And that white oak loom became really famous to true denim heads. Cone Mills closed that factory about 4 years ago. And when they closed it, we bought the last remaining supply of Cone white oak denim. And as we celebrate the 150th, we are launching product with true white oak denim. And it is the last white oak denim you are ever going to be able to buy brand new ever again, because that factory is gone.
Selling $325 pair of jeans, I mean, it's a phenomenal story. The product is great, but the economy is slowing. What are you seeing in terms of demand for your jeans right now, given things have slowed down?
Yeah, so we knew coming into this year that we were going to be navigating a very challenging year, in part because last year was very bifurcated. We had a very strong first half as we were coming out of the pandemic. We grew 20+% in the first half. And then in the summer, kind of the bottom fell out as inflation started to impact the consumer, fear of recession started to grab hold, currency headwinds. And the second half, we were basically flat. We were flattish. So we have a huge base period in the first half and a soft base period in the second half. And this year, guess what? It's going to be the opposite. The first half is going to be really, really challenging, and we should see some real progress with some tailwinds in the second half. But, as I look at the consumer around the world, there is, first of all, the US market is where we are seeing the greatest challenges. In the first quarter, our US wholesale business was very challenged. We have two value brands that we sell in the key mass retailers in this country. Those businesses are both off double digits. The lower income, low to moderate income consumer, they are now making very tough trade-offs with their monthly budget. And they're literally to the point where they're making decisions about, do I really need another pair of jeans, or can I trade down from the Levi's value brand to a private label?
What's even below the Levi's value brand?
Private label brand at Walmart or Target. And those are the trade-offs that we're seeing. The Levi's brand, the Levi's red brand, our core consumer is in the $50,000 to $150,000 income level, and that consumer is still buying jeans. In fact, the U.S. denim market in the first quarter grew 1%, comping 16% growth first quarter a year ago. So the category is still okay. We're growing share. We're growing share with the core 18 to 30-year-old. We're growing share with women. And our business and the brand is still really, really healthy. But wholesale is very, very challenging for us right now, and especially the lower end of wholesale.
Compounding bank collapses, Silicon Valley Bank, Signature, First Republic. Have those bank collapses made fintech more important than ever?
It has, and the great thing about fintech is not scared. Fintech is not scared of a crisis. It actually looks at a crisis head on and figures out how to innovate. They look at what are the various ways that we can build, what are the ways we can innovate and get things done. And a crisis for fintech is just another opportunity to figure out what's next, how are they going to reach their customer, how are they going to deliver value, and how are they going to get more sticky in a moment like this.
And can fintech come out of these collapses more sticky? What would that look like?
Well, first of all, fintech is expansive. And when I look at different phases of a business cycle, this theme is all about thriving. We're talking about thriving in an advancing world, making sure that everyone's thriving. But there's three stages. There's surviving, there's building, and there's thriving. So fintech is always building. Fintech is always building on top of new technology. So when we talk about generative AI, we talk about blockchain. That's how fintech keeps moving through cycles. It doesn't stop the builders, and it doesn't stop those from coming out of a space and saying, what's next? I spent a lot of time this year in Singapore. We've been to the Middle East, Abu Dhabi. We are focused on Africa, and we're obviously focused on the US, Latin America, and we're out here looking at the different ways that people are attacking and attracting fintech innovators, investments, and where they are. So I would say for the US, we're a very mature market. We have a tech edge, we have investment edge, and so you're going to see a lot of fintech coming out of the US, and people are not stopping in this space. When you're looking at the Middle East, you're looking at a lot of investment. They're also attracting their policymakers, their authorities are welcoming, they're open for business. The EU is open for business. And so when you look at different markets, you're looking at where is the opportunity. When you go to Africa, there's a very digital native population that's ready to kind of go into tech, and they're ready, and they're actually innovating. They've leapfrogged, and they're at the space where everyone's in tech there. So I think that the outlook for fintech is really amazing. I think that any transaction that has a tech edge is considered fintech. Whether you're an organization, a corporation, or whether you're a startup, you're looking at where is my next tech moment? How do we use this tech appetite to build acumen so your users are out here doing more and being more productive with your tech?
There's also a lot of doom and gloom talk about a possible recession. So how does fintech fare then in a recessionary environment?
I look at fintech as recession-proof. And when I say recession-proof, I mean that fintech is not going to stop its movement. It's going to keep moving because there's always opportunity to build even in a recessionary time. It just means that you have to figure out, where does your customer, where does your user, where does your client, where are they going next? And making sure that fintech meets that need at every space of your life. I know fintech startups that have built and have gone out there in down cycles. They figured out how to get lean, they figured out how to get smarter and build more quality into their product, and that's what it's about. It's about quality, it's not always about size.
That's really interesting. So talk to me then, looking forward, if you had to distill it down, what is the outlook for fintech right now?
The outlook for fintech I see is this. I think about this in a big picture. We're here at the Milken Institute. We have the top leaders in business from all around the world. And I think everyone's asking themselves, what is the wealth of a nation? What is the wealth of your nation? And a lot of people are saying wealth is about human capital, human opportunity, human creation, ability to create. And fintech is right in the center of that. The outlook is, whenever you want to build the wealth of your nation, you have to go to fintech first, build from there, and make sure that it reaches the people so everyone can have economic mobility.
And actually, while we're here, before I get to the last question, how do you define fintech?
So I believe fintech is very broad, but I'll say this. Fintech is any transaction, any financial transaction that utilizes technology to scale its impact and its usage. So that's whether technology can be AI, cloud computing, blockchain, and the transaction can be anything from lending to currency to payments. And so whenever you're talking about any of those transactions and the technology that goes in and powers it up, that's fintech.